In yet another dramatic policy pivot, the U.S. Federal Reserve has sent shockwaves through global markets after signaling an abrupt return to accommodative monetary policy. The central bank's latest statement, delivered after its most recent Federal Open Market Committee (FOMC) meeting, indicates that interest rate cuts and renewed liquidity support may be back on the table, barely months after officials insisted that rates would remain higher for longer. The shift has unleashed a frenzy across asset markets. Equities surged to new highs, with the S&P 500 posting its largest single-day gain in over a year. Technology stocks, already trading near record valuations, skyrocketed as investors bet that cheap money will once again fuel growth. Cryptocurrency markets rallied sharply, with Bitcoin reclaiming levels not seen since late 2021. Even gold and real estate, traditional hedges against monetary uncertainty, spiked as investors sought safe havens amid the Fed's policy whiplash. Economists warn, however, that the immediate euphoria masks deeper structural issues. "This is déjà vu," said Caroline Mitchell, chief economist at Horizon Analytics. "Every time the Fed reverses course so abruptly, it erodes credibility and pushes asset prices further away from fundamentals. The ones who benefit most are those who already own stocks, bonds, or real estate, while ordinary households see little relief." Indeed, critics argue the Fed's repeated reversals exacerbate America's widening wealth gap. By reigniting asset bubbles, central bankers effectively reward the wealthy, who are disproportionately invested in financial markets. According to Federal Reserve data, the top 10% of U.S. households own nearly 90% of equities. Rate cuts and renewed bond buying thus inflate the portfolios of the affluent while leaving wage earners facing stubbornly high costs of living. For middle and lower income households, the policy shift offers less tangible benefits. Mortgage rates may ease slightly, but housing affordability remains out of reach in many U.S. cities. Meanwhile, inflation pressures could reignite if looser policy boosts demand without addressing supply constraints. "We risk a scenario where asset owners get richer, while renters and workers face rising prices and stagnant wages," said James Liu, senior strategist at Global Macro Partners. The Fed's flip also has international consequences. Emerging markets, already grappling with volatile capital flows, now face renewed instability as investors chase higher returns in U.S. assets. Currencies in Asia and Latin America tumbled following the announcement, raising concerns of financial stress in countries heavily reliant on dollar-denominated debt. Fed Chair Jerome Powell defended the move, arguing that shifting economic conditions required flexibility. "Our decisions are always data-dependent," Powell said. "Recent indicators suggest that tightening financial conditions could threaten growth, and we will act as necessary to support the U.S. economy." Markets appear convinced, at least for now, that Powell's pivot means the era of easy money is far from over. Yet with public trust in the Fed wavering and inequality deepening, critics warn that today's exuberance could sow tomorrow's crisis. "Every flip creates winners and losers," Mitchell noted. Unfortunately, the losers keep being the same households left behind by an economy that prioritizes markets over people. If you liked this video, don't forget to hit the like button. It really helps the channel grow. And be sure to subscribe and turn on notifications so you never miss our next breaking news.